What's up, guys? On today's episode of Full Signal, I sit down with Sonali Basak, the Chief Investment Strategist at iCapital. She is one of the smartest people who works in finance, and I really enjoyed our conversation about the K-shaped economy, the AI trade, what's coming next for markets and the economy next year, and much more. I hope you enjoy this conversation. Sonali, I know you've been doing a lot of work in the AI trade. Can you walk us through how you're thinking about this right now?
Yeah, there's a lot of reasons you have to think about AI from a lot of angles, isn't there? Because first, you have a moment in the markets where the concentration risk, everybody talks about it. It is as extreme as it's ever been. That top 10 companies accounting for more than 40, almost 45% of the S&P 500's market weight. That's one reason why we believe that you not only have to look at these companies as a group anymore, but the changing forces behind all the things that are within that group. So one thing that's really interesting at this particular moment when it comes to artificial intelligence is the narrative. Let's use Meta as just one example. The first half of the year, you had Meta coming out and saying, we're spending more on CapEx, and the market couldn't get enough of it. You saw the shares bid up. You did see, for example, Meta trading better than almost anyone in the Mag 7 for a while. It stayed among the top gainers for most of the year. And then you got to the second half of the year and the most recent earnings report. And what you saw is a change in that narrative. And through last week, you saw Meta being the worst, among the worst, if not the worst performer in that Mag 7 group. So how long does that dynamic last for? We think the narrative's changing for a few reasons. One is now the use of leverage when it comes to the AI trade. These used to be very cash flow heavy businesses, large free cash flow balances. And the question is, how much do you keep on spending on CapEx before you start eating away at that balance? When you look at projections for next year, Meta is actually one of the companies alongside Oracle of the major group of hyperscalers where free cash flow is actually expected to decline again. For the rest of the group, it's actually expected to expand. So it's a dynamic worth watching. And it's not to say that we think that the AI trade is ending. We just think that what comprises the AI trade is going to change over the next year or so.
Can you explain a bit more about the leverage component? Are you talking about the company's leverage, or you mean investors in the company utilizing leverage?
The companies. And it's a great question. I've heard some of your recent conversations talking about how comfortable retail investors have gotten with leverage. I think this is amazing because most of my career was built off of studying 2008, certainly not as deep as 1929, but there are some behaviors that were forgotten. And the leverage part of the story is an interesting one. When it comes to the large tech companies, by and large, the biggest of the big companies we're talking about are not extremely levered. In fact, when you look at this part of the cycle, the difference between now and the dot-com bubble bursting is when you look at the amount of debt that's been taken on to finance this boom, a lot of it has come from free cash flow. So there was a really interesting JP Morgan analysis put out in recent days that said, okay, we think that the amount that's going towards this spend is going to be closer to $5 trillion, more than $5 trillion. In that $5 trillion, around $1.5 trillion is expected to come from free cash flow. The other $1.5 trillion expected to come from debt. Now, what's interesting about that? These companies don't have a whole lot of leverage right now. They have room to take on leverage. And if you look at the companies that failed during the dot-com boom, in fact, some of them were very highly levered and still made it through, but certainly the ones that were highly levered and did not make it through, we're not saying leverage for leverage's sake is bad necessarily, but if you can't grow out of it, there's a problem for you. The best way to think about this, I think this is an important concept for anybody who's entering markets. If you take on debt to make an investment, that's money you have to pay back. So you have to be okay with that eating into your returns, don't you? And that's true if you're an individual investor or if you're a big company. I've talked to some of the smartest investors in the world. Some are really comfortable with taking on debt to add leverage. But there are equally a lot of investors who say, you know, I'd rather not owe anybody $1. Right? I'd rather not owe anyone $1 and have control over my own destiny. That's the trade-off you're making when you're talking about leverage.
Does any of the financing that we see around these AI companies, the idea of circular financing, Have you looked into that, and does that concern you at all?
Does it concern me to the point that I think it's going to completely upend this AI cycle? No. Does it concern me at the margin? This is where I think things are going to get interesting. Right now, when you look at the AI trade, there are certainly a lot of companies that are benefiting from it, but a smaller group of companies that are benefiting more than others, right? In a very large disproportionate manner, both in the private markets and in the public markets. Now, let's project 5 years out. What if those same companies are not the leaders in the future? And all the money that's poured into them today, right? From a systematic perspective here, that's a good thing for AI. It's a great thing for AI, actually, for the trade to broaden in that way. It's a great thing for investors who are looking for new opportunities today to get into potential leaders in the future, right? It shouldn't be that one or two companies are the only ones benefiting at massive scale. But does it concern me in the near term in that if those companies retreat from their leadership in any fashion, and there are these circular deals, then yeah, there's certainly money to be lost there at some point if that does end up being a drastic move.
So I saw in recent days, Michael Burry, the investor, Big Short fame, he came out and essentially said there are fabricated numbers in some of these big tech earnings. And with that, I think I don't know if that was the catalyst, but it was definitely a part of the recent pullback we've seen in tech stocks. Is this sentiment shift, do you think, something that we're going to see dragging on for a while? Do you think it was just a blip? How are you thinking about this?
Two things about this. I want to address the Burry comments directly because I think that there's a really interesting concept that he has been really pounding the table on that I think is an important one for investors, and that's depreciation. Let's put a pin in that for a moment. As far as the sell-off goes, something that is equally important to understand is I don't think Burry's comments set off the market, right? Earlier that week, you also had big bank CEOs coming up and saying you can see a 10 to 15% correction. If you looked at what the big banks were telling you, they were also telling you that all their large hedge funds their hedge fund clients were also feeling kind of stretched in terms of positioning. They're running at kind of max leverage right now. The hedge fund community has borrowed money, a lot of it, and they have been using it to trade. What that means is that when risk appetite becomes a little extended, which it had for that community, then you take your foot off the pedal a little bit. But let's talk about one more dynamic there, that you have retail investors that have pounded the table and bought all year. You have a moment now where, to an unusually high degree, according to Goldman's prime brokerage, you had retail investors piled into the same names as those hedge funds. So what does that mean? It means that when you're seeing sell-offs, they could be a little more exacerbated than what we had been feeling maybe earlier this year, pre-April, let's say. So when we're looking at these moves, we're trying to put them into perspective because we're trying to read through the noise and say, okay, is this a turnaround in risk appetite or is this just a marginal pullback? And that is really important at a time where there's so much fear mongering in the headlines.
Well, speaking of fear mongering, the biggest topic that everyone is discussing is comparisons to .com. Do you give credence to those conversations?
There are a few key differences. I can understand why everyone wants to have this conversation. A few key differences is that these companies are making so much money. Back to the free cash flow conversation, which is why you have to also watch so closely as to whether that story is changing to any degree. We're watching free cash flow. Now, back to the Burry comments for a moment here, because this speaks to that fear, doesn't it? What Michael Burry is saying is that you have all of this very expensive technology, and there is something that is called the useful life of that technology. And you see that useful life changing. Now, Amazon this year brought their useful life down by a year of their technological equipment, and they said that that was due in part to the pace of rapid technological change. Now, if they're bringing down the useful life, it creates another question. What kind of change is that to their earnings, right? For example, when Google increased the useful life of their assets, I want to say in 2023, it added billions of dollars to their bottom line. And so it does make a massive difference when you look at how they're depreciating these assets. And by the way, here's the big complication. When you depreciate assets faster, you get favorable tax treatment heading into the coming years. So there is a benefit you get Also, now that bottom line hit still exists. You would still take a hit, but you also still get potentially a benefit to free cash flow if you are able to depreciate those assets faster because you get the tax benefit. So it is quite complicated, right? There's money taken from here, but money added there when you do that. But it's also, to make matters more complicated, you overlay, okay, so if the useful life of these assets is, say, and I'm putting up numbers that have just kind of been thrown out there, instead of 4 years or 6 years, it's actually 2 years. That's a lot of money that could be stripped away from the bottom line. It's a lot of money saved in taxes. But if that useful life is much less, then what's the resale value? CoreWeave this week said that they actually sold, I forgot if it was them or a client, but the resale of those H100s was only 5% less than what they earlier cost. That's an incredible statistic because that is showing you that even the old equipment was fine, actually, in terms of the value, even if they're not being used to the same capacity that perhaps these hyperscalers need to use them at today.
So I think what you're saying makes total sense. And to be clear, I'm very optimistic about the AI trade still. I don't see that much weight to the dot-com bubble comparisons. But something that I've been hearing a lot more from some of the folks I've been speaking with, they're watching a rotation out of tech into other corners of the market. Are you observing that, or do you think that's also maybe a short-term blip?
I'm going to lean on you a whole lot here because I do think that people throw around a lot of words. Rotation. I mean, people have been saying rotation all year long. You heard people say rotation when it came to the small caps throughout the course of the summer. We have a debate on this on our team, how we should categorize this. Is it a rotation? Is it a broadening? Maybe at the margins. Realistically speaking, most of the year that you did not see so much money rotate out of the tech names to buy something like a small cap or gold, right? You still saw markets today are still near record highs, so how much of a rotation are you really getting? With that said, there has been a massive wealth effect. It's very rare you see 3 years in a row with this kinds of double-digit performance when it comes to equity market performance. And it's not unnatural at this point to say, okay, tons of people are sitting on tons of wealth clients in particular are sitting on a lot of cash, not America writ large. I want to be very clear about that because the K-shaped economy is also an important aspect of this. But to the extent that you have money with a financial advisor, there's still substantial cash balances. Goldman Sachs said among the high net worth clients that they surveyed, I want to say a fifth of their assets were in cash. A fifth. HSBC had told us a couple months ago that long-only investors were still roughly only 60% invested at the end of the summer. So they missed the rally. And so these are some pretty incredible statistics that show you how afraid people have been. The rotation, I would say, we want to see a broadening. We want to see people notice, for example, we love financials. Financials had been trading into this week at a 13% discount to the broader S&P 500, despite outperforming on their earnings. I think that that's an incredible opportunity too, because you take a look at exactly how the earnings are coming in and you look at how much of this market has been trading on momentum and you see the dislocations, maybe things that are not being bought because they are great investments, but things that are being bought because other people are buying them.
Can you share a bit more about where you see opportunities in the market right now, maybe beyond the AI theme?
Yeah, financials is one thing we think has been underloved for a lot of reasons. Yes, it has seen a run up, but one thing that's kind of interesting, think about this moment alone, right? Government shutdown on the brink of ending here. 40 days, right? 42 days now. How many days are we at? I stopped counting.
Record time.
Right. Once it became a record, you stop counting. And so what happened was in that process, that IPO boom really slowed down because you couldn't get those listings through the SEC in order to see those listings. So what then happens? They get pushed to next year. for the most part. And so that capital markets boom, or at least comeback, is a really interesting one that will be very lucrative for the banks, the biggest banks. But not every bank has a capital markets business. So how do the medium and small size banks begin to fare in this environment? We still see loan growth. It's still quite healthy. What happens as rates come down? Then perhaps the return on some of those loans start to change. It's a real interesting question. With that said, too, capital markets is many things. Capital markets is not just IPOs coming back. A lot of people are talking about all that money going into debt markets. Banks underwrite that debt. If they're not underwriting it, private credit is writing it, right? So speaking of leverage, America's built on leverage, right? So this is definitely something we're watching because that insatiable appetite to lock in these yields, not in government debt, but in other forms of debt, has remained.
Can you talk a bit about alternative investments and maybe some of the private market trends or opportunities that you're watching right now?
Yeah, let me talk about a couple areas that are interesting because certainly private markets are something clients ask us a lot about. We also have a huge structured notes business. So clients ask us a lot about that. These are financial advisors who look to lock in their upside, maybe double-digit percentage returns depending on the type of scenario you're in, but really mitigate their downside risk. So instead of, investing in these high-flying hyperscalers or other AI themes in the public markets, they will do it through other forms of products. I know you've talked about this in forms of ETFs before, structured notes or other types of derivative-linked products or options-linked products. On the private side, we were talking about credit for a minute. One big question about credit after this massive boom that we have seen is how do people feel about it going into a lower rate environment? You might have seen all those headlines around how, we're kind of past that golden age, right? I want to explain why you might be hearing that. So private credit, the spreads, so the ultimate return you're going to get above public markets are higher, right? But the base rates, as interest rates get lower, they're coming down. So of course, that means it's not just private credit. It's just credit where you're going to see yields likely be lower. So I want that to be very clear. Now, as far as credit quality and underwriting goes, I think a lot of people are talking about this in the market now. How bad could it get out there? It's not that you can't see more of Jamie Dimon's cockroaches. We certainly have seen some, but writ large, credit quality for all the bad headlines that you see out there has held up quite meaningfully. And so credit is an interesting and meaningful diversifying part of your portfolio. With that said, our clients are getting back into private equity. And they're getting back into private equity through growth equity and venture in particular, because you look at public markets and they say, well, wait a minute, these have already been bid up. What are our opportunities of tomorrow? What are our opportunities in the future to be capitalizing on these big themes? I take a very balanced view here because equally what we're doing is having a lot of conversations with different fund managers around, well, wait a minute, fine. AI could be a great theme for you to invest in different ways. Data center infrastructure is another one. That's something that's getting a lot of interest. But what about all the companies that you currently own that might be disrupted by AI? That's the question I think people should be asking far more than they are today.
Do you mean they should be getting out of those investments that will be disrupted?
Or making sure they're future-proofed? Right? If you know that AI is going to, we're so early. We're so early. Most industries are just starting to harvest the potential of artificial intelligence, the efficiencies that you could see on it. You had another guest on that I'm very excited to see that episode. I won't reveal his name in case it's not out there yet. But, we talked about to what extent AI will eat into our jobs. Right. The reality of the situation is I don't see it that different to what happened when the internet came about, where you learn how to use it. You learn how to make your job more efficient through it. And it's here to stay. What are we all going to do? It could either take over the economy, or it can be a great tool that's used to advance the jobs that exist and create more jobs to make this a more productive workforce, which is not exactly what you're seeing today.
Real quick, we'll get right back to the interview. Just wanted to pop in and say, if you like this content, I write a newsletter every single morning called Opening Bell Daily. I cover macro, the stock market, asset prices, why things are going up, why they're going down. And if you want to get that for free, you can sign up at the link in the description. Let's get back to the interview. It's interesting because we are going to see jobs probably evaporate, honestly. And that's, I don't think, there's no like pleasant way to say that. But with that, I think there's going to be a bunch of new jobs and new industries that are going to come from innovation. And we've seen that many times over in different cycles. How do you tie, let's say, this AI theme to maybe some of the struggle and the pain we're seeing in the labor market, K-shaped economy? Because I think that's something people can't stop thinking about. If investors are making a lot of money in AI, the rest of the non-investing world could be seeing a different story.
You know, it's interesting. I just started month 3 of my job. Day 2 of my job, I had interviewed the New York Fed president, John Williams. And I was very interested in talking about this because day 1 and 2 on my desk, what we were talking about is the strange dynamic we're in. You probably have been talking about this a lot with investors, that the labor market has become quite stagnant at the moment. Low hire, low fire, but productivity has held up throughout the course of this year. When do those two things collapse? When do you have labor start to meet up to productivity, or productivity decline to meet what's happening in the labor market? Now, it was interesting. The New York Fed president's point of view here is, yeah, you at the margins do have AI becoming a huge question mark, but even he would say it's too early to know how much of an impact. Then you had Christopher Waller speaking to Bloomberg a couple weeks ago, providing another interesting observation that I thought was very important at this juncture in the economy, which is, you know, it's really easy to blame AI headlines for all the job losses. But in reality, you had a lot of companies also telling him that they were holding off on hiring and even maybe creating some efficiencies here because of concerns around managing their business around tariffs. So is it tariffs or is it AI? That, to me, is hard to see how much one of those things is impacting the job market versus, say, the other at this juncture. Because if you look at the aggregate data, and of course, we haven't had a lot of it, the White House said this week that you're probably not going to get CPI data for October and for jobs data as well. I'm kind of bummed about that. I'm not going to lie. And it's because if you had taken a look at the data up till now, it showed you actually that jobs, as much as people were so afraid of how much they've been falling off, were actually trending in a direction that was consistent with a low hire, low fire environment and not like a mass firing environment. It actually wasn't a job market that had fallen off a cliff. Now, with that said, we're at a precipice, right? Does AI create some cover for companies to create more efficiencies that they otherwise would not have done at this juncture? I don't know. But it is a moment worth watching so carefully because this economy at this point can go one way or the other.
I think Amazon, Walmart, several others have blamed AI for recent layoffs. And it's interesting you bring up tariffs because maybe it's true. It's not really AI. Maybe it's just the uncertainty of the moment and they're trying to hedge their business. But then on the other hand, part of me, I think this is an optimistic take. I think if they really believe AI is going to be world-changing tech, they're going to need a smaller workforce. And it's hard to know which one I'm leaning towards. I think, okay, do we want to bet on the tech or do we want to just say we have no idea what's going to happen because of the tariff uncertainty? Where do you fall on that?
It depends on the job. I would say, and I think that this is also an important, the optimist in me says, okay, everyone can throw their hands up and say, AI is going to take all these jobs. It's horrible. It's inevitable. I don't believe that. I believe that we're at a moment where we can look at this workforce and say, well, okay, if AI is going to be a big productive force in this economy, then what exactly is it creating? What productivity is being created through this novel new technology? And how do we mobilize a population around those goals, around those productivity goals. How do we train? How do we educate? How do we make sure people are getting into entry levels at jobs that would suggest that we can grow this economy through this amazingly productive new technology? Because can you really have productivity without that labor force participation? I don't know. I'm doubtful.
Well, I think a lot of the fear is how young people especially can't get these entry-level jobs because the entry jobs are the ones that AI is going to eliminate quickest or altogether. I don't know. So how do you, let's say with the AI trade, back to investing, how do you account for geopolitical or maybe extraneous factors when you're thinking about it as an investor?
I'm so glad you asked this. This morning, I was at an event helping moderate a bunch of discussions with Semaphore, and it was the Semaphore Dubai Business Forum. The reason this was interesting was because the Middle East has become a very strategically important place for a lot of reasons. It is physically at the center of the world, if you will. It's where the global East and the global West are able to kind of meet in the middle. You have companies there that are forming from the US, but also from China. You have investors from both poles of the world really coming together here. So, yes, this is a geopolitical story. It's a measure of national security. I've had the great luxury of talking to a bunch of CEOs in the AI space at some of the biggest companies lately. And, one thing they say is that it's not just that all these industries are going to start adopting AI. It's sovereigns. It's nations that need to be investing on this because this is a matter of national security. There's a lot of levels to think about that, right? Because on one hand, this is not just on how future battles are won and fought, but it's a matter of, economic security is part of national security, isn't it? And if AI is what's going to create that productive force in the future, again, you can't do it without leaving an entire workforce behind. And also, it creates all sorts of other issues, right? The midterms next year will be a really interesting barometer of this. How much, if you keep creating a K-shaped economy, then the government has to lean more and more on supporting that divide. There's no ending that vicious cycle, is there? And so it is complicated, but it's pretty clear that you have countries across the globe investing in this, as well as companies across industries on a more micro level.
With all that in mind, moving into the next year, what are some of the, you think, underappreciated risks that maybe most people don't know about or that, let's say, clients are asking about? What are you seeing?
Is this the what keeps you up at night question?
Maybe. I think so.
Yeah. It's funny because I think one of the great joys of my job is I get to speak to CIOs across the whole country of all different sizes of wealth managers. And what we do is we share our thoughts on, okay, what are you thinking about? What are you worried about? How are you protecting your client portfolios? Because we're at this juncture where if you had been invested in equities writ large over the last 3 years, you've done well, right? Depending on how much of a stock picker you are. But so now all these CIOs are sitting at a juncture where, part of the reason that there's fear is because, as one person put it to me, can the prosperity train keep running? And also, by the way, the prosperity train feels strange as a concept when it comes to the American stock market when so many people are being left behind, doesn't it? And so the K-shaped economy is definitely becoming more and more problematic. And remember, the reason it's becoming more and more problematic is twofold. One is that we've been going through it for years now. Certainly, COVID was a big moment that this dynamic was exacerbated for a lot of reasons. But then now, years later, we're still talking about it. And we're still talking about it from how companies are approaching their client bases, right? You see it in retail companies. You see it in airlines. You see it in financial services. But then also, you have to remember that inflation, which has remained around 3% essentially for years now, it disproportionately impacts the lower income earners than it does the higher income earners. Partially, by the way, because equities have liked inflation, right? Similarly speaking, I remember a conversation I had with David Rubenstein, a Carlyle co-founder, years ago. And he looked at me and he said, realistically speaking, I don't know how you get out of this debt load without inflating your way out of it. Right. So inflation has not hurt everybody equally. And so when we think about next year, how much of a burden is that going to continue to be when you have some of the most critical services in America, housing, food costs, still pinching this hard? So that bothers me on a personal level. You wonder when it's going to make any sort of a difference to the market because the market has ignored it. And then also just, the turnaround of this AI trade. There's so many people so levered to it that what's next? I would also caution, right? Volatility has been not that high for most of this year, right? Last week, we saw the VIX finally get back above 20. 20 is, and this is back of the envelope math, but I believe Lynn Martin told me this too recently, if you want, for citable reference, the New York Stock Exchange president. 20 is that moment where, okay, maybe it could get a little harder for capital markets activity to take off. So you see a VIX at 20 and an IPO, it's not that it can't happen, but it's probably a little less likely than if the VIX were below 20. So if we see volatility start to pick up, then there are ripple effects to that. Similarly, I watch short-term funding markets as well really closely. That's one of my specialties, I think, of my whole career, just kind of understanding and knowing the dynamics and when the Fed has had to step in there. It's not my short-term fear. If something had happened to U.S. funding markets, the Fed at this juncture would have enough firepower to step in. I worry more years down the road about this dynamic. At what point will the Fed stepping in just not be enough to save the market? This is a long-term worry that I have that most people don't share because, we've been fine for decades. But to me, it is just that the Fed has stepped in so many times, particularly since 2008 and arguably before, that at what point can they no longer really provide extraordinary support to a market if something really bad were to happen?
Well, I think a term I've heard many people discuss, the Fed has outlawed bear markets. They're always going to be the backstop. They're going to protect investors. And they get a lot of pushback from, let's say, everyday consumers. But the Fed has pretty much proven their willingness to save markets. So can you share a bit about where people can find your work and where they can follow you?
Yeah, absolutely. Everywhere online, I guess. I have a newsletter that I write every Friday still. I've maintained that. But also iCapital.com. I'm very, very, very proud of the research that we've been putting out, especially, before I joined, it was great. But since I joined, I made us ramp up the research a lot more. And so you can find it at iCapital.com. And also you can find our podcast on YouTube, on iCapital's YouTube channel.
Well, I really appreciate you coming on the show, and you do great work, so keep going.
Thank you. Thank you for having me. Appreciate this. I love your show.